by RBI is I would say, a precautionary measure. So I think that we have looked at in the past where there have been high credit growth in segments. In some of the instances, it has been followed by a cycle of NPAs moving up. So I think the regulator, probably rightly so, has looked at high growth in certain segments and is wanting to be more cautious to build in capital buffers to ensure that we don't have too much of a problem or a systemic risk going ahead. That said, if I look at the actual numbers which are coming out, I don't see too much of even at the NPA level or at the SMA level, numbers actually move up for the portfolio as a whole, but in a very small sliver, which is the less than rupees 50,000 unsecured loan bucket, there we have seen numbers, delinquencies go up, but that portfolio itself is around 2% of the overall unsecured loan book. So I don't think there is a systemic issue building up, but yes, there are certain lenders who have a very high proportion of this particular portfolio. There one needs to be careful, but at the same time, many of those in our portfolio are well capitalized with leverage at less than 2x. So even we do expect NPAs to go up, but I think many of these players are well capitalized to take that on their chin.
I would just like to add out here, see, I think to FY 23 and in the first 6 months of 24, the credit cost have been too good to be true. Actually, some of the players have showing negative credit cost. This cycle cannot be, you can't have negative credit costs continuously happening. There would be some change because what we are seeing is absolutely a tremendous run. What is happening is RBI had come out with 2 restructurings, the COVID restructuring 1 and COVID restructuring 2. And a lot of NBFCs had restructured anywhere between 2 to 10% of their books on this restructuring. Now, all of this is opened up. All that moratorium is gone. You need to start the cycle. The 2 years are completed. And now if that portion of, say, NBFCs, which has between 2 to 10%, that cycle is managed well in the next 1 year. I think that will help in a large manner to override the credit cost. But certainly the FY23 first 6 months have been extremely good for banks, NBFCs on the credit cost. It's too good to be true at times. There may be, the reality is that you will see some amount of pressure which will come in because of the restructured assets completely being opened up.
What were your numbers, Krishnan? Do they buttress what Sarosh is saying?
Yes, I think it would vary from entity to entity. Mine was more at a sectoral level.
I mean for the universe of, say, public sector banks, private sector banks, NBFCs.
So for the banking sector, we have a growth projection of 13 to 13.5% for this fiscal.
No, that is loan growth. I meant, he's speaking about bad loans. NPA, do you see it increase?
We do expect on the retail side and some bump up in NPAs, but we expect that to be limited to 20 to 25 basis points.
Okay, 25 basis points.
Yes, and it could be a little bit higher on the unsecured, low-ticket unsecured side.
Okay, I want to come back to this topic of asset quality and as well, therefore, the NBFC relation to Fintex because they are clearly impacted a little more by the new rules. I'll come back to you all in just a minute. Let me get the other 2 members also in. Ajay Kaval, how do you see a small finance bank's role in the scheme of things? Do you see also a conscious move from unsecured to secured? Or are you all very well placed in your unsecured because you all have their savings data as well? So just tell me what your experience may be.
So morning and Lata, always good to talk to you. So yes, see, financial inclusion is what small finance banks began with. And I think financial inclusion was misunderstood as microfinance. So everybody is graduated to affordable housing, doing micro labs, doing vehicle finance, getting into gold loans. Because I think fundamentally as a bank, you can service customers, right? You can really be the financial services hub for everybody. Which if you actually look at the middle to bottom end of India, that kind of focused offering was missing. So I think small finance banks have graduated. They've moved towards secured, but largely in line with what customer expects. So he doesn't have to go to 5 different spots to buy stuff. Second, small finance banks now total asset size about 1.85 lakh crores. So it's grown well. It's passed through COVID. It's kind of done extremely well through the COVID period. So I think they become resilient. they become sustainable. And probably what was in the past known as an experiment of RBI is now known as a successful business model. So that's my take. I think on consumer credit, the reality is that we will be all well served to slow down. Obviously, RBI from its vantage point can see things we can't see. And rightly so. They have a large collection of data and they can see early indicators. It doesn't point out to a problem coming, but it does tell us that if we don't slow down, the problem will happen. So I think all of us should take keen interest in that. I think NIMs will compress, not significantly, but I think with the credit cost coming down, you may see the profit margins still remain very intact. So I think unlikely NIMs won't contract, but I don't see profit margins being impacted.
Slow down, but not impacting margins. Okay, Rajiv, actually a slightly way out conversation for you. The terrain of the CIO has suddenly shifted a bit. I mean, there are some changes. One, of course, is that earlier this year, you saw the debt mutual fund tax advantage being taken away. And now, the biggest issuance in corporate debt, the NBFCs, have been faced with some challenges. How do you see the terrain? Do you think this is going to be a difficult year for debt mutual fund AUM growth?
Sorry, what was the last question?
Debt mutual fund AUM growth.
Okay.
Do you think that's a challenge?
Yeah, okay. You're right, in fact.
Closer.
Hello, yeah. In fact, you're right in terms of there's been a significant amount of change in the taxation which definitely has impacted the growth of the overall debt AUM piece. But what we have seen is there is a compositional shift. Where is money actually coming in? It is coming at more at the shorter end of the curve, largely the money market space, whereas the longer term debt funds have not really grown after that spurt that we saw when in
March.
Yeah, in March. So that is where we are today. But I would say in terms of these regulatory changes that have come and its likely impact on the market, it's in a way an opportunity for a debt product and a debt mutual fund at this point, because very clearly the impact of this would be widening of spreads. And as that happens, and we are probably closer to the peak in the rate cycle, I think that becomes an opportunity for debt funds to actually take advantage of. But the other challenge there would again be the extent of limits that one may have, because we've also gone through a lot of regulatory changes in terms of the amount of exposure that you can take to NBFCs having been brought down, alongside these taxation impact that we have seen. So, and the third is again very important. You had a large issuer, which is HDFC Limited. Now for us, in classification, that has become an NBFC, right? So the amount of space that you have to actually take advantage of any spread widening is constrained. And I think that is the constraining factor, even though there's an opportunity.
But one man is going to laugh all the way to the mutual fund because of that.
Yes.
Less competition from a giant called HDFC gives more space for other HFCs.
Always good to operate in markets where there is less competition. So we welcome less competition. Thank you very much.
Okay. All right. I guess HFCs are going to have an advantage. But let me come to the, we've spoken enough on the Reserve Bank's risk weights and the impact it has had. But following that risk weight, the governor made a speech where he brought, to some extent, even more fears that they have with respect to algo-based trading. Now, he was referring to Fintex who use algo-based trading and requested that they should be recalibrated. But Mr. Chakrabarti, did you look at that speech? And preceding that, we had even Chola Finance in their second quarter conference call say that loan originations from their Fintech partners saw a slightly higher NPAs at the end of 1 year. I mean, after they seasoned. So, does your view of co-lending through Fintex change after these two events? The governor's speech and what Chola had to tell us.
See, at Shriram Finance, we do not have any co-lending with Fintech partners. So, I don't have a direct experience with that. I'll be very honest here.
But how did you look at that speech? You may be using this big word AI in your lending. Are you changing any algos?
No. We still are on the old traditional money lender. But somehow I feel that when we lot of these new age fintechs are coming up with, a lot of rationale for putting money into people's pockets. So I think we need to calibrate it. They're putting, they're actually creating a rationale on saying, okay, this guy is living in Bandra, I can give him 50,000. This is not going to work like that. It may initially, for you to build a volume, and your NPS tend to look lower because you are building the book on a monthly basis. But I feel we are actually going the wrong way in assessing the credit there. So I think the governor is entirely justified in what he is saying.
Oh, actually, that's very interesting, and I know Jairam will want to speak on that, but let me also get Rakesh to say. Rakesh, has lending considerably changed? What has been your experience? Not necessarily at only Aditya Birla. I meant generally as an industry veteran, the relationship with Fintex. Unfortunately, and I will hold this against the trust group, we should have had a Fintech in the panel because they were seen as the vanguards of financial inclusion and financial broadening. But do you see that considerably changing, this co-lending relationship?
So to your first question, credit has changed, especially the consumer credit, small ticket credit. The way it gets delivered to a consumer has changed. And yes, all these, whether the Aadhaar, the digital payments, the UPI, all of this was available earlier. But the COVID changed the consumer behavior, and people are much more open to doing transaction online. So small ticket transaction, whether it's a checkout financing or if they're buying something or BNPL, I think consumer is much more, now they are adaptive to doing transactions. So credit has, smaller ticket credit has changed and transformed in India and will do so. But we have to remember what we used to look, when we were doing traditional, we all come from banking background, when we used to look at a loan transaction, what do you look at? The capability of the customer and his, what his background is. So you will do a KYC, you will do his cash flow analysis. Everything today can be done online. So you're not compromising on the underwriting standards. What you're doing is all these journeys have become online because you can assess the banking behavior of the customer online. You can do a KYC immediately. The credit bureau has strengthened in India over the last 20 odd years. If you look at that's, especially on the consumer side, has become very, very strong. So if you look at all of this is what we used to do when we used to underwrite consumer loans then also 20 years back. So today when you underwrite this, the journeys have only changed. And that's the reason I think the credit is getting transformed in India, especially the small ticket loans.
No, I take that part that you are able to see more transactions. But look at the kind of example that Chakrabarti is giving us, that people staying in Bandra or people staying in Chembur and sending their children to a convent school. I was given to understand that one of the 160 or 200 algos also included people who set their alarm at 6 a.m. in the morning. That's what I heard. You tell me if you know about the nature of the algos and whether something needs to change there.
No, see, the
algos, what are the kind of algos you have heard?
Algos also, and everything has to risk rank. At the end of the day, everything has to risk rank. You can have thousands.
Can you give me some examples?
No, so geolocational, in terms of where does the customer work. Yeah, you know where customer works, within the, from where a customer travels and all. So there are a lot of indicators which risk rank. There might be a lot of them which doesn't even make difference. So a lot of information is available. How do you convert them into knowledge and build into an underwriting model? I think that is what is critical. So whether someone goes to X school or Y school, whether that really risk rank in the consumer behavior, we don't know. What we know is that the credit bureau scores...
You have co-lending with Fintex?
We have co-lending with PSU banks. We have co-lend, few of them, very few. But yes, with the...
But did you have to overhaul or ask deeper questions of your fintech partners after the governor's speech?
We ask deeper questions ongoing. We are in the lending business. When we give loans, we don't celebrate. When we collect the loans, then only we celebrate. So this deeper questions is there in our DNA. The day we underwrite a loan, we ask these. So whether we have a fintech partnership or whether we source it through DSAs or we source it through our branches, those deeper questions are asked when we underwrite these customers. So that goes, and we have forums where we evaluate the portfolio performance on an ongoing basis. In certain cases, especially, we do on a weekly basis. And we track the performance and what is the cohort, what is the through-the-door customers who are coming, what is their performance. So we have to be on our toes when we are in the lending business because we give loan for 3 years, 5 years, basis the cash flows of today.
Well, clearly the RBI must have seen some lack of due diligence that the governor, quoted chapter and verse and alerted the ecosystem. So, Sarosh, do you all have fintech partners?
Very little.
And have you all questioned or reviewed their algos?
Lata, less than 1% of our asset base today is through co-lending. But on the larger question of co-lending, I think it is here to stay. There are reports which talk about by FY24 or mid-24, the co-lending will cross 1 lakh crore of asset base. Now, see what is co-lending? Co-lending is all about a stronger balance sheet, using a stronger balance sheet, trying to work in tier 2, tier 3, tier 4 cities and have the reach. Now, if the combination is right...
I am not questioning co-lending at all. I am asking if you all had to review certain fintech partners who may be your co-lenders as to the algos they used, or have you even stopped new partnerships with certain people because of what the Reserve Bank said? Did it change your behavior? That's my point.
So as I said, we are more of an organic player. Our growth is more through our branches. So less than 0.5% of our assets are into the with fintechs and smaller players. But most certainly, in the last, even before the governor put the brakes on the entire thing, in the last 6 months, we've been looking at tightening the norms on this sector clearly. But Lata, when you speak about co-lending, the only thought which comes to the mind, it is personal loans. Mind you, I think what co-lending is doing, it will open up more asset classes. You will see home loans. It's already happening. There are platforms like HomeWheel, etc. You will see home equity coming in. You will see wheels coming in. And I think that is the strength of this. So when we talk about, asset class having a problem, it just goes to personal loans at all points of time, which is a given. There is stress. There is no two ways about it. But I think what the platform, what the co-lending will do, it will help you to proliferate into many asset classes.
No, I completely take your point, and that was going to be my next set of questions for everyone in terms of what you see as triggers for, more products and more borrowers. But Jairam, just the last word on, the governor's speech and therefore the near-term impact.
Yeah, I think there will be an impact on fintechs, Lata, in the short term. I would not be surprised if in the next 2-3 months, you see multiple fintechs out in the market trying to raise equity. It has to happen. Why? Because a lot of the fintechs and fintech NBFCs are almost 100% unsecured, which essentially means the increase in risk weight on unsecured, which for players that are on the dais here, probably takes 50, 70, 80 basis points of capital. It'll end up consuming 500 basis points of capital for the fintech NBFC, right? And all their margin of safety is going to go away. So they're going to be much closer to the edge. So that's one reason. And the second reason is on an incremental basis, every bit of business they book is now consuming higher capital. So their burn of capital has also increased. So their margin of safety has gone away and burn has increased. There is no choice but for them to raise capital. So you're going to see a spate of fintech NBFCs either selling out or trying to raise capital. And that's a direct consequence of what RBI has done recently. From the lender's perspective, NBFCs are banks that have done partnerships. We have a lot of partnerships. We work a lot with the fintech ecosystem. And clearly in our portfolio, we have now had to make a clean distinction between NBFCs that are doing small ticket business, fintechs that are doing small ticket business and fintechs that are doing larger ticket business. And small ticket business, you're going to have to take your foot off the accelerator, and you cannot fund as much balance sheet to them as you were doing yesterday because it just is riskier, it's taking more capital and so on. So availability of balance sheet to those fintechs that are doing only small ticket business is going to be much more challenged in the months ahead.
Well, that certainly will get into the macro calculation as well. But to counter all this, there is one big macro that stood before us yesterday, which is the scorching pace of growth of the economy itself. So, Krishnan, on that, I mean, the theme of this discussion is fuel for growth, BFSI, the growth fueler. In the medium term, do you think that we have to we will come across an inflection point in terms of a quantum jump in terms of the pace of growth?
So I think you're right. When we look at the economy, India is the fastest growing large economy in the world, and it will continue to be there for some time.
Faster than we thought.
Yeah?
Faster than we thought.
Actually, just coming to that, we have actually revised our growth projections upward. We were at 6% GDP growth for this fiscal. We have upped it to 6.4%. And over the next 7 years, we expect an average GDP growth of 6.7%. So we expect that trajectory to be strong. And if that trajectory has to be strong, there will be a demand for credit, a demand for funding. If I look at broad averages of the last, say, 50 years, if I look at a credit growth as a multiplier of nominal GDP growth, broadly the number is 1.3x. So, for instance, if the nominal GDP growth is 10%, you need a 13% bank credit growth to manage that. So today, maybe that number will be a little bit lower because there are other forms of fundraising options available, but still it has to be at least equal to the nominal GDP growth. So if I'm looking at a 6.4, 6.5 real GDP growth, 4 to 5% inflation, that's still 10 to 11% credit growth. That double-digit credit growth has to be there. But at this point of time, we are seeing both banks and NBFCs, from a balance sheet perspective, reasonably well equipped to manage decent credit growth. If you look at capital adequacy, we look at asset quality, we look at profitability. Some of them are at either decadal highs or all-time highs. So for instance, net NPA in banking system is at an all-time low. A PCR, provisioning coverage ratio in banks, is at an all-time high. So some of this balance sheet consolidation has been there. That said, what we also need to have is a development of the alternate funding avenue, so say the bond markets. So that's something which is also a theme across the day. And we feel, if I look at a more long-term horizon till say 2030 or so, we expect the bond market, there will be green shoots for the bond market. We are projecting a 2.5x growth in the bond market from here till 7 years hence. And there are some green shoots, I'll just quickly touch upon that. We do expect CapEx cycle to pick up from second half of next fiscal. So that will necessitate
the CapEx
cycle. So today, if I look at the last few years, the CapEx has been heavy lifting done by the government only. We haven't seen private sector CapEx pick up in any meaningful way. Now we are seeing corporate balance sheets being delevered and capacity utilizations in various sectors reaching that point where fresh CapEx will start. So maybe next fiscal second half onwards, it should start. The other aspect is on the infra space. We have seen a number of structural shifts happening, which has reduced the credit risks in that sector. So we feel that the capital market will be more interested in putting money in infra space. So that's another angle. The other thing, of course, we are talking about NBFCs. We believe more NBFCs will now, over a period of time, shift to the bond markets because the retail growth in the NBFCs will outstrip the overall credit growth, and more retail NBFCs will be more granular granular retail focus, credit risk on a, I would say, spectrum based will come down. So bond markets will start looking at them. And again, increased financialization of household savings through managed investment products. So that will also help grow the bond market. So yes, bank credit, NBFC credit will grow. We feel bond markets will also grow. All put together, we should be in a position to support credit growth. The angle here is from the banking side, how much the deposit growth will happen, because you can't see credit growth isolated from deposit growth. So raising funding is also an issue. For NBFCs, asset side has not been too much of an issue in the past. It's been liability side challenges which have been the more pressing issue. So if they can manage their liability side, where partnerships with banks will be important. For banks, it is important for them to keep deposit growth. In the last year, deposit growth was 500 basis points lower than credit growth. This year, it's come to 250 basis points lower, but it should keep pace.
Okay. So, well, let me toss the same thing to Rajiv. Rajiv, the bond markets are going to be beset with another important factor as well, which is this huge amount of FPI money. We know for sure that from starting June 28, there is at least $25 billion that is going to take away the sovereign credit. It is unlikely that the other two bond indexes will not step in to include. It may be a matter of time. If it is not in June, it could be probably in the second half, but it has to follow. So how does that change the terrain? When FPIs take away that, do you see a lot of corporate paper coming in, or even for that matter, the HTM rule? How do you see bond markets in the next 1 year and the slightly longer term that Krishnan spoke about?
Yeah, in terms of the FPI flows that are expected given the index inclusion, very clearly it will have a beneficial impact on the sovereign curve, because we know the flows are largely in those FAR securities. There will be spillover effect on the corporate bond market, but to answer that question...
The behavior of corporates and banks will also change, no? When somebody else is coming and taken away the G6.
Yeah, yes. But I think from a corporate bond market perspective, I think the bigger story is the domestic pool of capital. So leave aside the mutual fund, which will of course grow in line with the broader growth. The long-term domestic investors, whether it is pension funds, NPS, insurance, so their AUM growth has been substantial in the last few years. And I think that's that pool of capital, the domestic debt capital, which can actually be, which will have the capacity to fund longer-term corporate bonds. So that is something that is going to significantly support the development of the corporate domestic bond market. Banks, again, the change in the HTM rules to some extent that can have a beneficial impact on corporate bonds as well. But that is something over a longer period of time. I think for the very near term, there are challenges in terms of absorption. FPI flows will definitely benefit the sovereign curve. I'm not sure to what extent that immediately impacts the corporate bond curve. So my sense would be initially we should see widening of bond spreads, and then over a period of time, as the domestic pool of capital is willing to step in and support the corporate bond issuances, then you see spreads tightening. As it is today, the spreads are extremely tight. Yes. I think we need to see a phase where spreads start to widen. That makes it interesting from an investment perspective, both for FPIs as well as for the domestic.
Okay. Well, I guess they will open up the spreads as sovereign paper finds more buyers. And if Krishnan's prognosis that and Jairam's, that there will be a worsening of credit in some places. So you could see credit spreads also widening. Ajay, the other end of the universe for you, how are you looking at the financialization? You know, the governor may have warned about algo-based trading, but it is a fact that there is vastly more digital footprint. So how do you see financialization at the bottom of the pyramid?
So my sense really, Lata, is that when the RBI says algos, etc., see, the lending apps had a few challenges, right? They were very charging a lot of huge interest rates. And obviously the algos allowed them to do it in a way that you didn't know what to expect. So you charge a lot more, so you can take a lot more risk, right? And so if you're charging 40%, you can take a 10% loss, and it works for you. Yes. So I think there is one issue around what you charge. And second is around transparency. That are you telling a consumer what he is really paying? So I think those two are the real issues. And I think as a lender, what probably I read in the signal is we should ask our partners, what is your transparency levels? What is your pricing levels? And then we have to decide that do we want to lend to a lender who is comfortable in his model with a 10% NPA or a 5% NPA or a 15% NPA. I think that's the basic issue. I think where we are in our scheme of things, see the last mile is crucial because there is financial education. There is making sure the customer understands and behaves responsibly. So yes, digital, like Rakesh was mentioning, helps a lot. Today, you can really know a lot more about the customer. The delivery is very cost efficient. But I do think the last large piece around financial education, how to behave responsibly, how not to over leverage, how not to be consumption led. I think that is still open, and I think for us, that continues to be our biggest job.
No, I agree with you, but a lot of financial education, even of the lender, is needed because often the newly recruited borrower is left a little stranded. I have seen that too much in my ecosystem, that you want to hook till the person has bought your product, either a home loan or either an insurance product, and the later hand-holding has not happened.
So, Lata, the customer should not think, I'm getting a loan, what should I buy? It should be the other way around. And I think we run the risk right now of the customer saying, oh, I've got a loan offer, now how do I spend the money? That is, I think, what we should avoid.
Are you seeing a big expansion in your terrain, in your, at the bottom of the pyramid? A generation of kids whose parents are not educated but who have, city jobs. Are you seeing a very different terrain in tier 3, tier 4 cities where you may be operating?
So, Lata, one is, and a couple of years back, I'm talking about 4 or 5 years ago, the new to credit, right, was about 70%. The new to credit has dropped now to about 30%. Okay. So I think the amount of inclusion in the formalized sector of lending is very large. And I think fintechs have played a very good role in getting a larger base formalized into the...
Should we be happy about this change or unhappy? Does it mean that we have already given credit to a lot of people and that is why the NTC is falling?
Sorry.
No, should we be happy that the new to credit has fallen from 70% to 30%?
Oh, absolutely. So I think
That means credit, financialization has already reached.
So I think they're coming to the formal system. That's helpful for them, helpful for the lender. So that is very clear. Some sort of method, whether it is a fintech method or an MFI or a small finance bank or an NBFC, has managed to reach them. I think that is a big positive. And third, I do feel that once they bubble up, then more lenders will be attracted, which gives his next need of financial product will be very well met. Yeah. So okay. I think we are moving in the right direction.
Okay.
At the margin, we shouldn't spoil it.
Okay.
And I think the risk there is we get over exuberant, lend hard, lend fast, and stock price makes the big difference. So yeah, that's the risk.
Mr. Chakravarti wanted to add something.
I just wanted to add that I think that's where the below 50,000 personal loans, most of them are going, that new to credit.
Yes.
So, should we be worried? I don't think so, to be very honest with you, because you're lending to them, lending that money to a set of people who have started earning first time in their life. So obviously they have needs and they need to borrow. So I think we may be a little overreacting. Nothing wrong in being cautious, but we should not overreact.
We should not overreact. Actually, why don't you continue with that conversation and tell us how you see the terrain over the next few years. Are NBFCs likely to be the flag bearers of growth, or are regulations closing in too much too soon?
I can't comment on too much too soon, but obviously anything is too soon for us because we are in the industry. So, but yes, particularly for colleagues Rakesh, Jairam, for us, life is becoming slightly, I would say, torturous in the sense, on the compliance side. your teams are increasing, you have more, you're spending more time on compliance than
compliance.
Yeah. But I think there is no replacement for an NBFC. If you really, if the banking system has to do a last mile delivery and small ticket, I think they cannot, there is no way they can replace an NBFC. And I think the industry will continue to grow. If there is a constraint on liability side, we will partner with banks. Similarly, what the smaller finance NBFCs are partnering with larger, we will also partner with banks and deliver that credit.
Yeah. So, fair enough. Actually, you know, the regulator to some extent has only gone back, you know, post, what do you call it, pre-COVID levels. It's not as if they've increased the risk weight unreasonably. They've only gone back to the pre-COVID level, which was always 125 basis points for risk weight. But I guess for NBFCs, it's a new one, right? NBFCs even...
Banks lending to NBFCs is a new one.
That is a new addition. Rakesh, your thoughts are... I mean, clearly the licensing rules were also out. That internal working group seemed to indicate that they're not yet comfortable giving to conglomerates, giving banking license to conglomerates. And likewise, as Mr. Chakrabarti said, there is this risk hierarchy. And as you become larger, the extent of compliances for the top has also increased. So how do you see the medium-term growth? In spite of it, is it bright? Because, no, India is growing.
No, so if you look at, we have gone through the regulation and harmonization of regulations between bank and NBFCs, especially the large NBFCs like us. We are in the upper layer, where there is almost harmonization between us and the banks in terms of the regulation and the guidelines. In fact, in certain cases, we are already on Ind AS, which is on expected credit loss. Banks are still on the IGAP. And we follow both in terms of IRAC and I'll tell you, when I joined NBFC, it was 180 days used to be the NPA norms. We moved from there to 90 DPD to Ind AS, then IRAC. So I think we have seen this change in regulation, and in the last couple of years, the regulation, especially for the upper layer NBFC, has been on a regular basis. And we have complied completely, and still the business model really looks quite robust. I think we are in the risk management business. And the governance, risk management and compliance will determine how do you really grow in the next 3 to 5 years, to your question, and where do we see ourselves. If you manage your risk well, if you are compliant, if you are 100% from a governance point of view, if you are doing the right things, you will be able to sustain. And that's how we look at. So portfolio quality for us in terms of managing through the cycle, portfolio quality, very, very key for us because we are in the risk management business.
I mean, why I would have you dwell on retail credit a little more. Until, say, pre-COVID, NBFCs were big lenders to corporates. But now both banks and NBFCs have become very granular in their lending. You know, much more retail. You think NBFCs are up to it? It means a lot of expense on technology. No, completely. So investment, life is changing. We look at everything we do, it is on our phones. Yeah, so we have to invest. We have to provide a very simple journeys to our customers, seamless journeys to our customers. We don't have to ask for the same KYC from the customer. In terms of, so we have to invest. See, also the customer and consumer today compares us not with a bank. They are exposed to an e-commerce company. Once they place an order on Amazon, they can track when their product is delivered. And then they can exchange it and all. So I think the transparency which Ajay just mentioned, from a consumer point of view, it's so important and so critical that they should be able to do it themselves. Their loan application, their tracking of the loan application, the way they deal with the lender, I think so we have to invest in technology from an experience point of view. So I think there is no shortcuts there. Okay, well actually we are on borrowed time. We are well past noon. But yes, last word to you, Sarosh.
No, I was just adding on when you asked about that more NBFCs are more retail focused.
More granular for
more
sure.
More granular, more retail focused. So obviously with consumption going higher across, you will see that retail penetration, more granular will happen as we go ahead. But the accidents which happened with the NBFCs
in 2017,
17, yeah. 18, 19, we would see some rebalance start coming in certain areas. We would see that, especially in the SME space, you're seeing a lot of NBFCs coming into the SME space. SME will become the new retail. That's the next stage of growth which you will see because people will start looking at that sector. And I think with in the housing space, with HDFC Limited merging into HDFC Bank, there will be an opportunity for HFCs to look at some kind of growth in areas which banks may not find it very easy to lend. So I think that's going to help. There will be some amount of rebalancing as we go ahead, but primarily it will be granular. It will be retail focused.
Okay, just a very quick question, and that will be the last one. Do you all see debt IPOs? Your equity IPO from the Tata stable has done so exceptionally well. Will there be debt IPOs from NBFCs? I mean, Saroj, if you can say. I'm saying because SEBI has tried to tweak the rules a bit for debentures. It's still more onerous than for privately placed. But do you see debt IPOs at all?
Very difficult to say at this point of time because our private sector placement of bonds is fine.
Far easier.
Far easier. Banks are lending. But the only thing which I would like to add, Lata, out here is that there is some structural advantages to certain NBFCs when they are deposit-taking NBFCs, unlike others, because deposit-taking NBFCs is like a pull. People want to put into, there are systems which are developed, there are processes, money keeps flowing into the NBFCs through the deposit route. The public deposits or the debt IPO is more of a push concept at times. So
that's the touchy point.
Humble request to the regulator, make it a level playing field for everyone, all the NBFCs to be a deposit taking, and because it's a steady source of liability management.
Jairam, you echo that?
Of course, like you have heard my rant on this in the past. We absolutely need to have a greater level of access to public deposits. If on the one hand, regulator says there is too much interconnectedness between banks and NBFCs, so dear NBFCs, go borrow from somewhere else. Our sort of simple question is, where else? Who's the other part that's going to lend to us? And say, hey, go to the markets and borrow. And like, oh, but in the markets, the counterparty is still the banks. So how's that reducing interconnectedness at all? The only way to reduce interconnectedness is to actually give direct access to end depositors. And that needs to happen for more large players, for the regulator to really achieve the outcomes that they are looking to achieve in terms of creating clear separation between the industries.
I guess they are trying to push you all towards debenture IPOs, but yes, your point is taken. I think that's the full house of asks from the NBFCs, and the future prospect in any case looks bright, never mind the immediate, the near-term constraints that the regulator has placed. It clearly, it's only a near-term slowdown in terms of the pace of growth, but it's a very strong medium-term story that the NBFCs have in front of them. Thank you very much, Rajiv, Ajay, Rakesh, Mr. Chakrabarti, Jairam, Sarosh, and Krishnan for a very enlightening chat. Thank you very much.
Thank you, Lata.
I'm sorry if I have to take questions from the house. Ajay, you may have to wait a minute. Let me see if in the previous session, the audience was very kind to the panel. Will they choose to be again? Okay, I guess you all can catch up over lunch. Thank you very much, everybody.
Thank you very much. Please stay with me on stage. May I please invite on stage Hani Jalan and Anindya Sen from the Trust Group to present mementos, tokens for appreciation to the honorable panelists of this session. Ladies and gentlemen, please stay with us in this main function hall. Please settle down once again. We are heading straight into the next panel. We'd like to thank Mr. Rakesh Singh. We'd like to thank Mr. Sarosh Amaria, Mr. Vyas Chakravarti, all our esteemed panelists of this second panel of the day at IDCMS 2023. We thank Mr. Jairam Sridharan, Mr. Ajay Kamal, Mr. Krishnan Sita Raman, and Mr. Rajiv Radhakrishnan. And of course, thank you very much to Lata Venkatesh for finally moderating the second panel of our day. Please come together for a group.